In this lesson, you're going to learn how to estimate the cost synergies in a bank merger model. Now, the first question you may have is how are cost synergies different from what you'd see from normal companies, and then also why are we not looking at revenue synergies in this particular model? I'm going to start with the revenue synergies because that is a bit easier to explain. The reason why we're not looking at revenue synergies here, if you look through the lesson list, you'll see they're not listed anywhere, they're not in any upcoming lessons, is that it doesn't really make a whole lot of sense for a bank to have revenue synergies if you think about it. The issue is that a bank earns a good portion of its income from the interest rate spread, and it would not be realistic to just magically assume that they can get a higher interest rate just because they've bought another bank. It's really out of their control to some extent. They can do a few things to improve their interest rate spread, but overall it's much more determined by the market forces than anything else. So very similar to oil and gas companies, for example, how they cannot control energy prices, banks cannot control interest rates, and so revenue synergies on the interest side doesn't really make any sense. Now, in terms of their other income sources here, you could potentially assume some kind of increase to these, but once again, many of these are also more market driven, and it wouldn't make much sense, for example, to assume that they can get higher investment banking or trading revenue just because they acquired the investment banking or trading team of another bank. It doesn't work like that, and in some cases it may actually result in less revenue if, for example, they were both working on the same deal or the same types of deals, and now they're not, or they were pushed off because you can't have the same bank advising both the buyer and the seller. So revenue synergies do not make a whole lot of sense for bank merger models, and that's why we're going to skip over them here. And even with normal companies, I should also point out that when you are looking at synergies, generally revenue synergies are just not taken that seriously to begin with. And so in general, you pay much more attention to the cost synergies, even when you're looking at normal companies where revenue synergies could potentially work. Now for the cost synergies, generally what you do is rather than assuming any type of interest rate differential or interest rate improvement in terms of the interest you're paying on the interest-bearing liabilities, instead you only look at the core non-interest expenses. Now, the exact definition of what a core non-interest expense is subjective and it varies from bank to bank, but generally the idea is that you assume some type of percentage savings over what they're paying for employees, technology, G&A, administrative and accounting functions, things like that. So you assume generally that when the bank combines with another bank, you don't need all the employees that you had before, you don't need all that administrative support, you can combine the infrastructure somewhat, and so that's where most of the cost savings are going to come in. Now how you estimate this, again, very, very subjective, but we're going to say as a baseline 10% for the synergy percentage right here. Now the reason we're doing this is because we just don't have enough information to really make a granular guess as to what this is. Ideally, we would talk to the CFOs of both banks and say, hey, here's the scenario we're considering. Which expenses can you consolidate? Can you give us an estimate of how many buildings you will no longer need, of how many employees you'll no longer need, of how much you can consolidate the infrastructure, and how much in cost savings that actually means? We don't have enough information to do that because all we have are their financial statements. We don't have a detailed breakouts of employees by function or anything. So all we can really do here is make a very simple estimate for the percentage. Now, for the core non-interest expense, we could define this a couple different ways, but if you look at the footnote here, the way we're going to define it is employee compensation, benefits, software, rent, tech, marketing, and other. So let's go over to SunTrust's financial statements. Let's be careful to get the 2011 numbers. So let's scroll down. And so what we want to take here are the compensation expense, the employee benefits. We also want the outside processing and software. We could definitely save some money on that. The occupancy expense, basically rent. Then moving down, regulatory assessments, credit, collection services, other real estate expense. Those are a little bit more questionable. I'm not going to include those. We will include technology and equipment because we can consolidate infrastructure in many cases. We can include marketing and customer development. Operating losses we are not going to include because that is not typically an item that you see listed there. These are operating losses. These are not related to real expenses that the company has in terms of employees, infrastructure, or rent, for example. So we have all those. And then the last thing I want to add here is to go down and take the other expenses as well. Now the rest of these in between, amortization of intangibles, that goes away anyway, so there's no point in including that. And then the rest of these are either zero or, in the case of mortgage reinsurance, it's not clear if we could actually save anything there because we're talking about an insurance expense that wouldn't necessarily get a better rate just because they are now a part of JP Morgan. So we're going to include those expenses right here. And what I want to do is actually enclose everything in parentheses, then multiply it by the percentage right next to this, the synergy percentage. So we get to 502. One other thing I want to do here is just flip this around slightly to put the synergy percentage in front. And then I also want to change everything in here to make it K, column K, because we want the 2011 number. Now that gives us the total to expect in 2011. However, the problem is that with cost synergies, especially when you're dealing with banks, you may not be able to realize all of them at once. So it may take many years to actually realize all of these synergies. What we're going to say here is that 50% are realized in the first year, and then 75% in the second year, and then after that 100% in years 3 and 4. Fairly standard assumption to see in bank merger models. It does take a while. When you're consolidating banks, it is quite a bit different from consolidating normal companies. Banks have these huge retail branches and networks, so they have a lot bigger physical footprint on the ground. It's a lot more complicated to actually consolidate everything. So that is why you often see this in bank merger models, but not quite as much in other types of merger models between different types of companies. Now, to actually calculate this each year, what we're going to do is take our synergy percentage right here, and then we're going to multiply by the realization rate each year. So we have that. Fix the formatting there. And then we can just copy this down. The only issue, of course, is that with all these, we need to shift the column one over. Now, unfortunately here, it's going to be a little annoying because we are working with rows in one case and columns in the other. So what we need to do is get columns L through N here for 2012 through 2014. I am going to go in and fix that right now, and we're going to skip ahead until after the point where I get that fixed because it's going to be very tedious to actually show you. So we have those in place now. Again, I just skipped ahead because it is a little bit tedious to go in and fix all of them. The next thing we want to look at is how much in restructuring charges we are going to have to recognize to actually make all these cost synergies take effect. Remember, it's going to cost something to actually restructure and to get rid of these employees, to consolidate infrastructure, and so on. And so we need to reflect that in terms of the restructuring charge here. Again, this is something that you don't see quite as much with normal companies because cost synergies there can be a little bit easier than what you see with banks, at least to implement. So you don't see this quite as much with normal companies. It can come up. You do see it sometimes, but I would say overall it's far more common with financial institutions. So generally what you do is assume that the restructuring charge is a percentage of your total cost synergies by the end of the period here. So maybe in years 3 or 4, when all of them are realized 100%, I'm going to go with the assumption of 150% and say that to get to this level of cost synergies, we're going to have to spend even more than we would save in terms of cost synergies each year. What that means is we can take this number and then multiply by the realization in 2014 to get to our cost synergy number right there. And then some of these restructuring charges will be in the form of cash, some will be non-cash. Very standard. You've probably seen both non-cash and cash restructuring charges on companies' financial statements before. Cash, of course, means whatever you're actually spending in cash flow to consolidate, to reorganize employees, to get the infrastructure up and running on the same system. And then the non-cash portion could be any type of expense you're recognizing, something like depreciation, let's say, that is an actual expense and represents an expense that will have to be paid back in future periods, but which you're not paying out in cash in the current period. So generally you assume this is a pretty high number, the cash portion. So it's not as if this is just going to be 10 or 20%. Usually it's at least in the 70 to 100% range here. I'm going to say 75% for our number. And then to calculate this, we can just multiply these two. We get to 526 for the cash portion of the restructuring. Now restructuring we're going to leave alone for now and come back to this in an upcoming lesson. But for the cost synergies, we can actually calculate the income statement impact of these right now because, again, it's fairly straightforward, fairly simple, not too much going on here. So let's go down to our cost savings schedule. And so what I'm going to do is take the seller's core non-interest expenses and put them in right here. Then we'll input our cost savings rate and our realization rate. Again, the way this is set up is not the best. Ideally, it's better to make it all rows or all columns rather than mixing rows and columns as we are here, but not the end of the world. I'm just going to go with what we have. And then to input all these expenses, once again, it is a little bit tedious to actually look at me doing it. So what I'm going to do instead is just input all of these. And then I'm going to skip ahead. I'm just copying these into a notepad file right now. So we have all those. Now let's go down to the cost savings schedule right here. And so what we want to do is take these numbers, the seller core non-interest expenses, and then once we get these in place, then we can fill in the rest of the schedule. Again, this setup is a little bit tedious, and we probably should have done this slightly differently, but I felt it was important to put the cost savings assumptions up there in the transaction assumptions, because that is something actually very important to look at with these types of models. Now for the cost savings rate and the realization rate, so the cost savings rate is just going to be the synergy percentage each year. So that is fairly straightforward. And then the realization rate, we're going to go up here again and take the realization in 2011 through 2014. So we will copy the synergy percentage across, and then this one, remember, we're going down by one row each time. So we have this in place. And then for the total cost savings, pretty straightforward. We're going to take the total core non-interest expenses times the cost savings rate times however much we're realizing in this year, and we will copy this across. So we have that ranging from 200 million up to closer to 500 million by the end of the period. Of course, we already knew this actually from our schedule above, so it's not as if we're learning anything tremendously new here, but it's good to have it in this format because it'll make it much easier to incorporate later on into our income statement. For the after-tax cost savings, we're going to take our cost savings number right here, multiplied by 1 minus the buyer's tax rate, and that's all there is to it. So nothing too terribly complicated here. Again, we need all these after-tax numbers because we are combining the company's net incomes rather than their pre-tax incomes, something a bit different with bank merger models that you don't see as much with other companies. And so that's why we need to calculate the after-tax cost savings. But overall, not too terribly complicated. Really, the main differences are that we do have a realization rate. Unlike what you see many times with normal companies, we also have a restructuring charge associated with it in both the cash portion and the non-cash portion. The restructuring charges, of course, we are not going into detail on right now because it takes some more work to go through and calculate the schedule for that, but we will come back to it in an upcoming lesson and go through it in detail, and you'll learn exactly how to calculate the cost of funding that restructuring, and then how the restructuring and the cost savings or cost synergies work together and have an impact on the combined company's net income.